What are the 5 biggest risks to your retirement? They're taxes, longevity, poor market returns, major health events, and inflation. In today's video, I'm going to walk you through one simple thing you can do in each of these categories to insure against that risk. Let's start with taxes. Taxes can be a major risk to your financial plan and your ability to remain comfortably retired. The question is, where are taxes going to be in 20 years or 30 years? You probably have strong opinions, but sometimes our opinions and reality don't perfectly align. This is why I actually like to view Roth conversions as a form of tax insurance. Now, typically when we're talking about Roth conversions, it's because of all the money Roth conversions can save you. And this is totally accurate. Roth conversions can save you tens or hundreds of thousands of dollars or even more in taxes over the course of your retirement when executed properly, but they go beyond that. Roth conversions can also be a form of tax insurance. What do I mean by that? Well, I have a couple of term life insurance policies on my life. I hope those term life insurance policies become a complete waste of money. If they become a complete waste of money, what does that mean? It means I didn't die in the term that I have those policies for, and it means life went well. Things went as I would hope that they would go. Well, let's apply that to Roth conversions. Let's assume we do Roth conversions because we believe that taxes are going to be higher in the future. Well, if taxes are higher in the future, we end up saving a lot of money by doing those Roth conversions, again, assuming we did them properly. What if taxes are lower in the future? Well, in some instances, those Roth conversions can actually become a complete waste of money now because we end up converting at a higher rate than we otherwise would have if we had simply withdrawn money later when tax rates were lower. However, the insurance piece of this would look at that a little bit differently. It would say, wait a minute, I'm okay with quote unquote wasting some money if taxes in the future are actually a lot lower than I anticipate them to be. Why? Because every other aspect of my financial plan is better off because of that. It's kind of like that life insurance thing. I'm okay wasting money on term life insurance because it means that if I didn't use it, it means that life ended up going as well or better than expected to with these insurance policies. So same thing can be held true with Roth conversions. If you do them and tax rates go up, it saves you a lot of money. If you do them and taxes go down, well, then your overall tax bracket is lower and your financial plan and the probability of success that it has is probably even higher despite the fact that you wasted money on those Roth conversions. So in that sense, you can view Roth conversions not only as a means of saving money, but also as a means of tax insurance, of insuring against what could potentially go wrong in your retirement. The second risk to your retirement is longevity risk. Now, in the grand scheme of things, longevity and life expectancies increasing overall is a great thing. But with retirement planning, it's actually a tremendous risk. And it's a risk because running out of money is a very real concern. There's no guarantee about what the stock market's going to do. And when you retire and you have your nest egg, there's no guarantee that that's going to last you the rest of your life. So longevity becomes a very real concern that if you live longer than your portfolio, you're going to be in a tough spot later on in life, where you end up relying upon family members, friends, or worse, and you just don't have enough money to last you for the rest of your life. So that's a very real risk. How do you protect against it? Well, one thing that you can do is maximize your Social Security benefit. When we hear the term running out of money, that immediately instills these senses of fear and concern and how horrible that's going to be. Now, for many people, it absolutely would be. But imagine running out of money if you and a spouse had a fully maxed out Social Security benefit. Now, it's not fun to know that you don't have any liquid reserves to supplement what you have coming in from Social Security, but you have to ask yourself, how far would that Social Security benefit go in covering your basic needs, covering your basic expenses? If you have enough coming in income to meet all your monthly expenses, then to a degree, it does not matter how much you have in your portfolio. Your portfolio is there to create income to meet those needs, but if you already have sufficient income to cover those needs, then the portfolio or lack thereof becomes a much lesser concern. So ultimately, one way that you can insure against longevity risk or the risk of not having enough income later on in your life is by maximizing your Social Security benefit. Now, you also want to ask yourself the question of how much do you want to depend upon Social Security for the next 30, 40 plus years of your life? There's going to be some change to the system, most likely. The system's under a tremendous amount of strain that it just cannot support. So ask yourself to what degree are you comfortable with that? But if Social Security does continue in its current extent, which I know is a big if, that's one way to protect against longevity risk. The third risk that you need to insure against in retirement is market risk. There is absolutely no guarantee that the stock market will continue going up. I will say that when you consider the enormous weight of evidence we have historically, there's a very high chance that the stock market continues to go up over time, but there's certainly no guarantee. And even if it does continue going up over the next, say, 50, 60, 70 years, What if the next 10 to 20 years, the market has a horrible return? And what if for those next 10 to 20 years, that happens to coincide with your exact retirement? You're not too concerned about how the market's going to do over the next 100 years. You're more concerned about those first 10 years, those first 20 years of retirement. What happens if those 10 to 20 years are very poor returns? How would that impact you, your portfolio, and most importantly, your ability to do everything that you want to do in retirement? That's a very real risk. And one way to actually insure against this is via an annuity. And this is quite literally an insurance product. So an annuity is a contract with an insurance company. Now, I'm not saying you should start with an annuity or everyone should have an annuity. And in fact, in almost all cases, I'm looking for other opportunities, many other opportunities or options to use before considering an annuity. But if you truly want to insure against something and get a guarantee against something, this is where an annuity can come into play. Where if you purchase an annuity, and there's many different types of annuities, but more than likely, you're going to get lower returns or lower income than you otherwise could have created through simply owning a portfolio of great companies and bonds and managing that in a way to create your income going forward. However, there's no guarantee that you would get that return. So with an annuity, what you're doing is you're lowering your ceiling on how high of returns you might potentially get, but you're also raising the floor. So you're getting a more predictable outcome if you know exactly what you're going to get, where almost certainly in many cases, it's going to be a lot lower than what you otherwise could have done. However, the worst case scenario is going to be a lot better than what could have happened in a purely market portfolio or other types of traditional portfolios going into retirement. As I mentioned before, I always at least pretty seriously consider other options to use before exploring the alternative route, which is annuities, but annuities very much can have a place in a retiree portfolio. The fourth risk that you need to insure against in your retirement is the risk of a major health event. Now, how can this hurt you outside of course, the health reasons? Well, if you have the wrong health insurance or lack of sufficient long-term care insurance, this can become a major financial burden to you. So how do you insure against this? Quite simply, it comes down to having the right insurances in place. Before age 65, do you have the right coverage, either through your employer if you're employed, or through the marketplace or COBRA or some alternative if you're not employed? 65 and beyond, do you have the right Medicare coverage to cover your specific needs and to cap against any catastrophic losses? Really, the goal of health insurance isn't so much actually health related, it's financial related. As I've mentioned before, you can get all the right coverage even without insurance to cover any needs that you have. It's just going to cost you a tremendous amount of money. So the risk of a health event in retirement is, yes, the health aspect of it, but more so it's the drain that's going to have on your portfolio. Could that totally devastate your portfolio and leave you without money to cover you for the rest of your life? Same thing goes for long-term care insurance. Now, what I don't love about long-term care insurance is these policies have maximum lifetime benefits that they will pay. So it's not like a health insurance where once you've paid a certain amount out of pocket, all of your future needs are covered, assuming you have the right policy. With a long-term care event, they will give you a lifetime maximum benefit that the insurance company will pay out. Because of that, there's sometimes alternative ways to self-insure. Let's assume, for example, you are single and you have $500,000 of equity in your home today, and you have income from Social Security and pension and investments to cover all of your needs. The risk is, what if you have a long-term care event? With that long-term care event, it costs $200,000, $300,000, $400,000. Well, do you look at the equity in your home to say, if something happens, that's my trigger to sell my home and use that equity to pay for this event, or get a reverse mortgage to cover any potential event? And because you can align the equity in your home with what the maximum benefit will be on a long-term care insurance policy, you can self-insure to an extent because you can align those coverage amounts. And I'm not saying this is the only way to do it. I'm not even saying that's a great way to do it. But just using an example, that long-term care insurance policies, it's not saying that if you have this, you're out of the woods. If you have it, it can be helpful. In many cases, you do certainly need it, but it's not going to cover everything if you stay in a long-term care facility or if you have long-term care needs that extend beyond the lifetime max benefit. But the bottom line here is that you do need to have a plan to insure against this. Right health insurance coverages, both pre and post Medicare, as well as long-term care insurance that can either be actual insurance through an insurance carrier, or it can be part of your plan and your strategy to have certain assets set aside that would cover that event in the case that it was needed. Now, another simple thing you can do today to protect against both of these events is take care of yourself. Yes, we want to get the right insurance coverages, but to what extent are we eating the right way today, exercising the right way today, taking care of ourselves today? This actually ties into a lot of retirement planning. If so many people put off retirement, and it's those last few years of work that really take a toll on their body, both mentally with the stress and the demands of the job, as well as physically, knowing that you're not able to prioritize your own health, or at least you're not taking the time to prioritize your own health. So making sure that you're eating right, staying active, staying healthy, that can be one of the best things you can do, even beyond having the right insurance coverage and long-term care insurance coverage. Not that that's going to guarantee against everything, but it's stacking the odds in your favor. So yes, get the right coverage, but also make sure you're taking care of yourself, because that's what's going to allow you not only to be as active and healthy as possible in retirement, but also potentially keep the costs down of those health events later on. The fifth major risk that you need to insure against in retirement is inflation. Now, inflation is one of those risks that until recently, we didn't really see it year by year, but we absolutely felt it over longer periods of time. Take a look at the screen right here. What this shows is the impact of inflation on the purchasing power of $1 since 1980. $1 in 1980, if we use that as our benchmark, was worth $1 in terms of its purchasing power. But as inflation has increased over the last 44 years or so, what you can see is what has that done to the value of $1. The end of 2023, $1 in 1980 was worth about 27 cents at the end of 2023. That's just the natural impact of inflation. We need to insure against this. In retirement, it's not enough to preserve your portfolio value and say, okay, I'm protecting against risk. More important than protecting the value of our portfolio is protecting the purchasing power of everything that we need to spend money on over the course of our retirement. How do we do that? Well, one of the best ways that we do that is by purchasing stocks. Now, this is ironic to a lot of people because most people think that in retirement, owning a lot of stocks is risky, but it comes down to how do you define risk? If risk is volatility, then yes, stocks are absolutely risky. But volatility is just the degree to which the actual return of stocks fluctuates around its average return over time. If we look at volatility in the short run, the volatility of stocks is very high. If we look at volatility in the long run, it's almost boring how consistent stock market returns are. I want to emphasize again, this is no guarantee that this will continue into the future, but if we look at this chart again, going all the way back to 1926, what you see here in this gray is this is the impact of inflation over time. Meaning, by the end of 2023, it would take $17 to purchase what $1 could have purchased in 1926. So the average cost of goods since 1926 is increased by 17 times. Now, it's very evident that the inflation is not distributed evenly. When you look at the cost of homes or healthcare or technology and vehicles, all of these have different inflation rates, of course, but on average, inflation is about 17 times higher. Well, if you look at things that are traditionally considered safe, like government T-bills, you can see that T-bills over that same time just marginally outpaced inflation. So what does that mean? It means they stayed stable, but it didn't actually protect your purchasing power a ton. Now, it maintained your purchasing power, but it didn't really increase your purchasing power. That's where stocks come into play. If we look at this blue line right here, this is an average return of large US stocks of about 10.3% since 1926. By the way, 1926 is right before the Great Depression. So including that tremendous setback that the market faced for several years, even within that, the market still averaged an annualized return of 10.3%, which means that $1 in 1926 turned to $14,538 at the end of 2023. If we look at small company stocks that over the same time period have averaged 11.8% return, $1 would have turned to $57,813. So as we actually look at stocks, we need to redefine a risk because inflation becomes a huge risk to our portfolio and our plan, especially when we go back to this chart here. If all we ever did was preserve the dollars in our bank account, well, the value of those dollars is going to go down quite dramatically over the course of our retirement. That is why we need to own assets, and we need to own assets that are appreciating at a rate that is higher than inflation. Now, stocks aren't the only way that you can do this. And a lot of people say, well, isn't that why people own gold? Shouldn't we own gold in our portfolio if we want to protect against inflation? There have been times, certainly, that gold has helped to protect against inflation when inflation was unexpectedly higher than people expected. But consider this. Since 1971, which is when we stopped pegging the value of a dollar to gold, since 1971, the value of gold has increased by about 8% per year annualized. If we look at the S&P 500, since that same time, the S&P 500 has increased by 10.5% per year on an annualized basis. So right away, we see that stocks over that long period of time, 50 plus years, have outperformed gold. But then consider this. Since 1980 until now, gold has only increased by an annualized return of about 3.2%. Why was that? Well, from 1971 to 1980, gold absolutely did incredibly well. Why was this? Well, you could argue, you can make a very compelling case, that the value of gold was artificially kept very low over the preceding several decades as the dollar was pegged to it and there was laws around what the price of gold should be set at. Once that peg was removed, the value of gold skyrocketed, and if we just measure the price increase from 1980 until today, it's hardly outpaced inflation. Now, if we look at the S&P 500, from 1980 until today, it's averaged 11.5% per year. So sure, you can make the argument that gold can be a hedge against inflation. But what I'm looking at is simply owning stocks that have real purchasing power, that have real profits and dividends. Compare that to the value of gold and what it's increased by, and you can make a determination for yourself of what you think is a better inflation hedge over time. So those are 5 major risks that everyone faces when it comes to their retirement planning, and it's crucial that you have a way of insuring against each of them. One of the big risks I talked about was tax risk, and I mentioned that one of the ways that you could insure your plan against future tax increases is by implementing the right tax strategy today. Well, to do that, you need to start by understanding what are the 3 big mistakes that most retirees are making when it comes to their tax strategy. I made this video right here where I walk through the big 3 mistakes I see way too many retirees making and what you can do to avoid those risks. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.